more. Today, we're tearing down an advanced price action scalping strategy for both crypto and Forex, one that literally turns market traps into massive opportunities. If you've ever felt like the market is just out there personally hunting you, well, you're absolutely going to want to pay attention to this. Let's kick things off with a pretty painful question, one that literally every day trader knows all too well. How many times have you entered a breakout only to watch the market instantly reverse and hunt down your stop loss? I mean, it's incredibly frustrating, right? You do all your careful analysis, you confidently jump in, and boom, the market flips just to take your money.
All right, let's get right into it. Part 1, the fake breakout trap.
So, there is a huge fundamental difference between a trap and a true market move. A fake breakout is basically engineered by the market to grab liquidity. It's meant to trigger retail stop losses by tricking you into thinking the trend has shifted. On the flip side, a real breakout, that's where the smart money is actually entering the true trend. The whole key to profitability here is knowing exactly how to tell them apart before it's too late. You see, the anatomy of this trap is almost always exactly the same. The price breaks a recent support or resistance level, instantly retail traders get super excited and open their positions, or maybe the slightly more cautious folks wait for a Quasimodo or QM level to enter, which is essentially just a specific head and shoulders reversal pattern. But then, the tragic part happens. The market just instantly reverses direction and stop losses get smashed across the board. The crowd literally becomes a liquidity for the big players. Which brings us to part 2, mastering the uptrend reversal. Okay, to identify a true profitable reversal in an uptrend, you've got to watch for 3 exact steps. It's kind of like a combination lock. First, the market gives you a fake breakdown, which totally tricks sellers into thinking the uptrend is over. Second, it rallies up to form a single higher high, and that traps all the late buyers. And then third, the real breakdown finally happens, dropping right past the bottom of that initial fake out. That final break, that's your true, reliable signal to get in. Now, I cannot stress this enough. The absolute non-negotiable point here is the word one. If the market makes multiple higher highs after that initial fake out, just walk away. The pattern is completely invalid, the whole story changes. It absolutely must be just a single peak before the real breakdown. That's how you confirm the trap has actually been set and sprung.
Okay, let's flip it. Part 3, mastering the downtrend reversal.
In a downtrend, you're essentially just looking for the mirror image of what we just talked about. First, wait for that fake breakout upward. The crowd thinks the downtrend is finally over, so they aggressively buy in. Second, the market suddenly drops to create a single lower low, and this is specifically hunting the stop losses of all those eager buyers. And then finally, step 3, you enter long the second the price surges past the peak of that initial fake breakout, because that right there is the real move. And here's a pro tip to dramatically increase your accuracy with this strategy. You really shouldn't just be trading these patterns randomly anywhere on the chart. You want to look for these specific true breakout setups around major structural order blocks or flag limits. These are essentially the hidden zones where massive institutional money clusters. When you combine this precise price action pattern with those significant structural zones, your success rate is going to climb significantly.
All right, let's see this in action. Part 4, real chart examples.
Let's look at this heavy Bitcoin downtrend. Just like we outlined, a fake upward break happened right here, totally trapping those early buyers who were convinced the bear market was over. Then the price pulled back, formed a single lower low, and just swept everyone's stops. And then, finally, it aggressively broke past that initial fake-out resistance. That was the real entry point. By having the discipline to just sit on your hands and wait for that true breakout confirmation in Bitcoin, instead of jumping the gun on that very first move, traders could have caught a massive, verified upward trend of over 70%. Honestly, this just perfectly highlights why we let the trap spring on someone else before we make our move. Now, let's pivot over to gold for a second. During this strong uptrend, the market showed a fake breakdown. Sellers immediately jumped in, but then the market rallied back up to print a single higher high. That took out all the sellers' stops and completely trapped the new late buyers. It was only after this specific sequence that the true market crash actually began. Catching that true breakdown entry in gold right after that final higher high, that yielded a mind-blowing drop of 16,000 pips. Guys, whether you're trading Forex, crypto, or commodities, capturing a move of that magnitude is just a total game changer. It really goes to show how incredibly powerful these patterns are once you know exactly what you're looking for. All right, before we wrap up, part 5, the 30% rule. I've got a really stark statistic for you here. According to data from Binance, a staggering 96% of futures traders are losing money. That means only 4% are actually profitable. And you want to know why? It's not because their technical analysis is bad. It's mostly because they completely lack strict capital and risk management. They just let their emotions drive their sizing. But here is the absolute craziest part about that statistic. You can actually be in that elite, profitable 4% minority with a win rate of just 30%. Yep, you heard that right. You can literally be wrong 70% of the time. As long as your risk-to-reward ratio is strictly 1-to-1 or better, and you aggressively manage your capital, you are still going to come out ahead. Because the ultimate truth in trading is this: strict capital management will beat perfect predictions every single time. Honestly, even if you were trading using something as basic as simple moving averages, having proper capital management and keeping your emotions in check will ensure your overall net outcome stays positive over the long haul. So I really want you to sear this golden rule into your brain. Win rate doesn't matter, your net trading outcome does. Look, I get it. Your ego desperately wants a high win rate so you can feel smart. But your bank account, it only cares about a positive net outcome at the end of the month. Always, always protect your capital first. So, here's what you need to do. I strongly encourage you to go back test this heavily on a demo account. Really practice identifying that single higher high or single lower low until you've completely mastered the pattern. So, the final question I have to leave you with today is this: are you ready to finally stop being the liquidity for the smart money and actually start trading the true reversals?